In this video, I am going to be showing you a powerful, mind-blowing day trading strategy that I always use consistently, and this strategy has been yielding so much profit for me right from day one. Guess what? I am talking about the moving average crossover. This strategy is so powerful that if you master how to trade it, you are going to be making profit daily. This strategy has over 96% win rate. This strategy works very well during a trending market, but it doesn't work well during a ranging market, because when there is a ranging market, the moving average crossover will give you so many fake out, or should I call it whipsaw. So it will give you so many wrong signal during a ranging market. So this strategy is only used during a trending market, and you should discard it during a ranging market. That is why I always advise you should always make use of price action alongside with indicator. So this moving average crossover strategy is going to be used alongside with price action, that is support and resistance level. So we are going to be using the moving average as our support and resistance level, right? So we are going to be trading the breakout and the pullback. So ladies and gentlemen, you are once again welcome to my channel. I still remain my humble self, Austin Ikeru, and you all are welcome to my channel, Austino FS. Moving average is one of the most popular indicator that so many forex traders are using to make money in the forex market. There are several strategies that you can use the moving average to implement. I've treated so many of it, but in today's video we are going to be looking at the moving average crossover. So this strategy is one of the strategies that I've been using from day one, and this strategy has been so profitable because with this strategy you are trading along with the trend. So in other words, you can call it trend following strategy. So now this strategy is meant for day traders, right? Scalpers can also implement it, right? And this strategy is also meant for swing traders, right? Now for you to make use of this particular strategy, there are things you need to understand. One, don't use it during a ranging market, and two, during a ranging market only make use of support and resistance level. This strategy works very well during a trending market and doesn't work well during a ranging market. So in this strategy we are going to be using the 5 exponential moving average and the 20 exponential moving average. So we are going to plot this two moving average and wait for a crossover. When the faster moving average crosses over the slower moving average, that is when we are expected to take action. So when the faster moving average, that is the 5 EMA, crosses over the slower moving average, that is the 20 EMA, from down to up, it means that the market has entered into an uptrend. And when the faster moving average, which is the 5 EMA, crosses below the 20 moving average, which is the slow moving average, from up to bottom, it means the market has entered into a downtrend. So what I'm going to do right now is that I'm going to show you an example, and after which we'll go into the live chart, and then I will teach you how you can implement this trading strategy in a live chart. I'll show you how you can plot out the indicator on your trading view and how you can trade it successively. Right now, for you to be able to trade using this indicator, you have to do what? Plot out only 2 moving average. Now this is the 2 moving average that I'm talking about. This is the 20 exponential moving average, and this is the 5 exponential moving average, right? So this 5 is the faster moving average, while this 20 is the slower moving average. So what you need is just these 2 lines. They will act as support and resistance level during a trending market, right? And a breakout of it tells you that the trend have changed direction. So what you're waiting for a crossover, right? Now if you watch here, you see that the faster moving average, which is the 5 EMA, the red line, crosses over the 20 moving average, that is the slower moving average, the 20 EMA, and the market entered into an uptrend. Now what happened again? The 5 EMA crosses below the 20 EMA and the price went into a downtrend. This is one of the simplest strategy that anyone can master, and with this strategy you are trading in the direction of the trend. But like I said, this strategy doesn't work well in a ranging market, right? Because during a ranging market there will be so many crossover, right? And if you decide to follow the crossover, you may get a hit so many times, because what you are getting is a wrong crossover, it's a fake crossover, because the market is in a range. So it works extremely well during a trending market. Now this is another example, right? You can see another example. So in this example right now, the red line is the 20 moving average, while the blue line is the 5 moving average, right? So if you watch, you see that the 5 moving average crossed above the 20 moving average and the uptrend begins, right? What this strategy does is that it helps you to identify a trend. It helps you to know when a trend is about to start, right? And it helps you to know when a trend is about to end, right? So whenever the faster moving average crosses above the slower moving average, it means an uptrend has begun. And whenever the fastest moving average crosses below the slower moving average, it means the uptrend have changed to downtrend. So that is how this strategy works. Very simple. So if you watch clearly in this example, you can see that the faster moving average, right, crosses above the slower moving average. The faster moving average is the blue line, right? It crosses above the red line and the price went straight into an uptrend. So at it being you caught this crossover, and maybe immediately the crossover occurred, you place your buy trade and maybe put your stop loss below here, you will be able to ride this massive trend, right? Now you also watch for another crossover. So when the faster moving average crosses below the slower moving average, right, it means the trend have changed direction. So what you do is you simply close your buy trade and open a new sell trade, and you'll be able to ride this powerful trend. So this strategy is purely a trend following strategy. So like I said, it works very well during a trending market and doesn't work well during a ranging market. So you should always know the market structure before you implement this strategy. Now this is another example, right? You can see the 2 moving average, the faster moving average and the slower moving average, right? In this scenario, the blue line is the 5 EMA, which is the faster moving average, while the red line is the 20 EMA, which is the slower moving average. So I told you that the signal of this strategy is a crossover. So you wait for a crossover. When it occurs, you take action. So now you can see clearly that a crossover has occurred here. You can see that the blue line has crossed above the red line, which tells you that the market has entered into an uptrend, right? So once you notice the crossover, what you have to do is to wait for the candlestick that caused that crossover to close, right? If the candlestick closes and the height of the candlestick from the crossover is not that too long, you can easily place your buy trade at the close of the candlestick. But if the candlestick is too long, then you have to wait for a pullback, right? Because if you place a buy trade when the candlestick is too long or overextended, the price might reverse and maybe hit your stop loss. So that is why it's advisable that you look at the height of the candlestick. Right now you can see that the crossover has occurred, and this is the candlestick that caused the crossover. Right, so you can either place your buy trade at the close of this candlestick and put your stop loss below the crossover, or you can wait for a pullback and place your buy trade when the price comes back to test the 20 EMA, and then put your stop loss below the 20 EMA. So any of them can work for you. So once you have done that, you can now ride a trend. You can see how massive the trend is. Then where do you take your profit? You take your profit when there is another crossover. So the moving average is one of the most reliable signal that can give you money in the forex market. So like I said, this strategy worked extremely well during a trending market, right? So like I said, once the crossover occurs, then you have to wait for the candlestick that caused the crossover to close. And once the candlestick close, you can now place your buy trade and then put your stop loss below the moving average, that is the 20 moving average, right? Then if you want to ride a trend, you can simply trail your stop loss, right? You can ride a trend and wait for the next crossover. So where do you take your profit? You take your profit here when the faster moving average crosses below the slower moving average, right? You will now know that the trend have changed direction. So that is where you are expected to take your profit, right? So once you take your profit, you can still place a sell trade and then put your stop loss above the moving average, and then you can be able to ride the downtrend. So this is how you trade the moving average crossover. This is how simple it is. So this is another example on how you can trade the moving average crossover. Like I said, this is one of the simplest strategy that you can implement in the forex market. Bear it in mind that you can use this strategy in any market, whether forex, whether crypto, whether option, any type of market, whether stock, commodities. You can use it in any market, right? This strategy works very well. Just make sure that you are in a trend before you can implement this strategy, because if the market is clearly in a range, please do not implement this strategy. Make use of your support and resistance level, right? So when you look clearly, you will see that the moving average crossover works very well during a trending market, and it doesn't work well during a ranging market. So I keep saying it, do not use this strategy during a ranging market. Once you discover that the market is in a range, please discard this strategy and make use of your horizontal support and resistance level, because this moving average crossover does not work well during a ranging market, because once the market is in a range, you receive several wrong signals. There's what we call whipsaw. You see the moving average crossing over each other countless number of times. You see the price crossing the moving average all the time, because the market is clearly in a sideways. It has no direction. So please implement this strategy only in a trending environment, and please, if the market is in a range, discard this strategy, right? So now this is another example, right? You can see the two moving average, right? The faster moving average is the red line, while the slower moving average is the blue line. So when the faster moving average crosses the slower moving average from up to down, you know that the market is in a downtrend. So you have to place a sell trade and put your stop loss above the moving average, right? Then you can be able to ride this trend. So where do you take your profit? You wait for another crossover. That is where you take your profit. So when this faster moving average crosses above the slower moving average, you know that the trend have changed direction. A new uptrend has begun. So what you do is you close your sell trade, right, and then open a new uptrend, and then put your stop loss below the moving average, and then you can be able to ride this trend. So where do you take your profit? You wait for another crossover. So this is where you take your profit, and once you take your profit from the next crossover, you can still place another sell trade, right? So once the moving average crosses below once the faster moving average crosses below the slower moving average, you can simply take your profit and then place a new sell trade, and make sure that your stop loss is above the moving average. Then you can ride this trend. This is how simple this strategy is, right? So but one thing I want you to understand about this strategy is that you are going to lose so many profits, right? Let's say for instance now you watched for the market to make a crossover, right? And finally you can get the crossover happened, right? You can see the red line crosses above the blue line, which tells you that the uptrend has begun, right? So you wait for the candlestick that caused the crossover to close. For example, this green candlestick is the one that caused this crossover, so you have to wait for it to close. Then watch the size, the height of the candlestick that caused the crossover. If the height of the candlestick that caused the crossover is a little bit short, not that too long, right, is a little bit short, you can easily place your buy trade at the close of that candlestick, and then put your stop loss a little bit below the moving average line. But if the candlestick that caused the crossover is too long, is too extended, right, is too long, you have to wait for a pullback, right? So please do not place a buy trade if the candlestick that caused the crossover is too long, because if you place your buy trade, maybe that is where the price will revise to make a pullback, and for the fact that the candlestick that caused the crossover has overextended, right, the pullback might be deep and it might hit your stop loss. So you have to watch the height, right, of the candlestick that caused the crossover. So now let's assume this was what happened, and this candlestick caused the crossover. You can see that the candlestick is very long, so you can simply wait for a pullback, right, for you to place your buy trade. Now this is the pullback. The price now went down to test the 20 EMA. So this is where you now place your buy trade and put your stop loss below here. Then you can now hold your trade for it to ride this trend. So bear it in mind that you are expected to take your profit when there is another crossover. So you can watch and see that there is no crossover here. You can see the price is going up, came here, make a little pullback, came here, make a little pullback, and then continue heading up. So the price, this is the highest point that the price got to, right? Now this is a massive profit for you, but because you have a rules that you are following, and that rule says you only take profit when there is another crossover. So you have to hold on to your trade for it to make this pullback. I know that this pullback is very deep, so that is the sacrifice you have to pay for using this strategy, right? You don't have to be greedy, because sometimes you have to lose some of your profits, right? Then you have to lose this profit, right, until you can discover that a crossover truly occur. The reason is this: you don't know for sure if this pullback is going to be deep, so you are just hoping that the pullback will not be too much, right? So if you watch this one, you see that the market went up, made a little pullback, and then continue heading up, right? Made another pullback, continue heading up, right? So this is the highest point that the market got to, right? So the market made another pullback, right? So your expectation is, if the market makes a pullback to the 20 EMA, it is supposed to to reverse, right? It's supposed to test the 20 EMA and continue heading up. But if eventually the market breaks below the 20 EMA, that tells you that the trend have changed direction, and if you continue holding, you might end up losing all your profits. So that is why it is advisable that you take your profit once you confirm that the price has crossed over, right? If you watch, this is a sell signal. The 5 EMA, which is this red line, crosses below the 20 EMA, which is this blue line. You put your sell trade. Then this is another signal, right? The faster moving average, which is the 5 EMA, this red line, crosses above the 20 EMA, the slow moving average, which is this blue line, crosses above it. It means the trend have changed direction. A new uptrend has begun. So you also need to close your sell trade and open a new uptrend. Then when the price got to this point and makes another crossover, it means the uptrend has exhausted and a new downtrend has begun. So what you do is you close your uptrend and then open a new downtrend, right? And then you can be able to ride the trend, right? You wait for another crossover, and this is the crossover, right? Once it occurs, know that the downtrend has exhausted and a new uptrend has begun. So you have to close your sell trade and open a new buy trade. So this is how you'll be trading the market consistently until you are satisfied with your profit. So this is the examples of how you trade the moving average crossover. So now let's dive into the main chart and show you example on how you can plot this a moving average in a live chart. So if you watch clearly, you can see that we are making use of trading view, and we are making use of gold 15-minute time frame. Take note, we are making use of gold 15-minute time frame, and this is a live market. So if you want to make use of this strategy, so the first thing you need to do is to go to the indicator, go to moving average exponential, this is it, and click it, right? 2 times, you click it 2 times. Moving average exponential, you click it 2 times, right? When it opens, you go to the setting. For the fact that I have it already, I'm just going to open it, right? I'll just enable it, right? Good. Now after enabling the moving average, you can simply go to the settings of each of the indicators, right, and make several settings. Like the style, you can change the color of the moving average so that you can differentiate between the faster moving average and the slower moving average, right? Then go to input, right? Then the method should be EMA, which is exponential moving average. Then the length should be 5. Then the time frame should be chart, which is all the chart, both 1 hour, 2 hours, all the chart. That is why you expect to place chart, so that the indicator will appear in all the time frame. Then after that, you can now click OK. It will save. If you want to increase this line, make it to be bold, you can simply click this. Then this is it, you can make it to be bold, right? This is the smallest, followed by this, and this is where I made it to be. So you have to make the line to be bold so that it will be very visible. After that, you can simply click OK and it will save. Then you come back to the second moving average, click the setting, right? Go to the input, make sure that the method is EMA, and then the length should be 20 because the first one was 5. So the first one, you have to go to the settings and make the length to be 5, right? Then you go to the method, set it to EMA, right? You go to the style, change the color like this. The color is black, so this is the black, right? This is the color black and this is the black. So you go to the opacity, or make it to be thick. So these are the thickness, right? This one is the smallest, followed by this. So you use either this one or this one for it to be bold. So you can see that the black line is very bold. After that, you click here and then click save. You go to the second one, the second moving average. You click setting. This icon is setting. You simply go to input, make the length to be 5, right? Then you change the method to EMA, which is exponential moving average. Then the time frame should be fat. The time frame should be chart. Then you go to the style, change the color. You can use any color you want to use, right? Make sure you use the color that will differentiate it. you go to the thickness, right, and make sure you use the ones that is very thick so that the moving average line will be more visible. Then you click OK, then it saves. So you can now have the two moving average. So now the two moving average has already been plotted on the live chart. So I want to show you how you trade this moving average. Like I told you, this moving average works very well during a trending market and it doesn't work well during a ranging market. Now if you look at the environment, you see that the market is in a trend. So now what happened? The faster moving average has crossed over the slower moving average. So in this scenario, you can see that the black line, which is the 5 exponential moving average, has crossed above the purple line, which is the 20 exponential moving average, and the price has started heading up. So how do you trade this strategy? You watch the price action and see what happens. Once this black line crosses above this purple line, right, then you wait for that candlestick that caused the crossover to close. So in this scenario, this is the candlestick that caused the crossover, right? Now it depends on the stop loss you want to use, the duration of the stop loss, right? If you want a tighter stop loss, then you have to watch the height of this candlestick, right? So this candlestick is not that too long, right? So you can simply place your buy trade at the close of this candlestick and then put your stop loss a little bit below the moving average. Then you can be able to ride this trend. So you are waiting to take profit when the crossover occur again, or if you want a tighter stop loss as this crossover occur, you can wait for a pullback, right? So this is the candlestick that makes a pullback to the 20 EMA. So once the pullback closes, you can now place your buy trade and put your stop loss a little bit below the moving average. Then you can be able to ride this trend. So this is how massive this trend is. You can see that the market now went up, came back here, tested the 20 moving average, went up again, right? You can see the movement, right? So this is how I trade this strategy, right? You have to be attentive, watch the market to see the action that the market is displaying. Like I say, this is clearly a day trading strategy. Scalpers can also use it. So you have to monitor the chart consistently to know when a new crossover has occurred, right? So because your action is based on crossover, that is what determines your entering and your exit. So if you can be able to master this strategy very well, you'll be able to ride massive trend during a trend, either up or down. So like I said, you have to make use of good money management strategy, because in this trading setup, there's going to be win and there's going to be lose. But the sweetest part of this strategy is that the lose is small compared to the win, because you are working with the crossover. So whenever the crossover occurs against you, you have to close your trade. Means you close smaller losses. But when the crossover goes in your favor, you ride a trend. So in this strategy, you are losing less and you are earning higher. So that is where your risk reward ratio plays an important role. So you are risking 1%, you are gaining 20%, right? So this is the powerful strategy that if you can be able to backtest it on your demo account, master it very well, you'll be making money consistently in the forex market. So ladies and gentlemen, my advice for you guys is to go to your demo account, backtest this strategy very well, make sure that you write down the rules, right? Write down the rules and follow it well. Make sure that you do not trade this strategy during a ranging market, only implement it during a trending market. So whenever you have done the backtesting and you confirm that your winning rate is higher than your losing rate, then you can now implement it in the real market. So ladies and gentlemen, I hope you love this video. If you do, give us a thumbs up. Don't forget to subscribe to this channel for more educative content like this, and also don't forget to subscribe to this channel for more videos. I still remain my humble self, Austin Ikeru, and you all are welcome to my channel, Ostino FS. Please, I encourage you to come back for more updates. Don't forget to share this video on your social media handle. I will see you again in my next update. Enjoy the rest of your day.